Happy Friday, everyone. Tell me the truth, you're going to miss these Fridays that we have homework reviews, where you have 1:30 to 2:30 where you're just like, I can't wait to get out of class, but I really, really also want to go through homework with Dr. Barnes. Yeah, yeah, yeah. You'll have some flashbacks and just kind of like, you know what? Those were good times. Probably during busy season when you're just kind of like, okay, I'm on Friday, which means there's only 3 more days in the work week. So, yeah. Yeah, yeah. I like to write. I did. Public accounting is actually not that bad. The way I explain it to people, everybody says that the recruiters they sugarcoat it and say the recruiters say that's just the most best job ever, and then you read on social media it's like the worst job ever. The truth is somewhere in between. It's a job, and there are good things and bad things about it, and there are definitely things that I can look back on and say, "Wow, I hated that," but there are some things I can look back and say, "Wow, I loved that." So yeah. It's not going to be different for any other job. So yeah, if you hear me joking about it, it's just that it's a joke. Let's take a look at the schedule. What do you say? So first of all, congratulations. You all deserve a round of applause. We have 100% submission on the Excel assignments. This is the first time that I can actually say that for any one of my classes that I've been doing the Excel assignments. So you're the first class in 5 years that has actually met that criteria. So congratulations on that. Now, I don't know what the Excel assignments look like. I've been checking with Matt. Apparently, you all operated independently, which means that either my instructions were really, really good or you all are just really that smart. So we'll see. Again, hopefully everybody did well in the Excel assignment. This is one of those things that I constantly harp on and say, please make sure you do it. This is, again, first class I can remember in a very, very long time, actually ever, that got 100% submission. So congratulations on that. What we have coming up. So next Monday, we will not be in here. All right. At least I will not be in here. I'm not going to judge what you all do. Okay. If you want to come and hang out in the room, that's fine. You all may have become close friends by now, want to hang out. Actually, Chandler and I, neither one of us will be here. So if you want to hang out with Chandler, he's not going to be here either. Yeah. I have posted the lecture to Brightspace, so you can work through that. Even a picture of me dancing along with Ray Gunn. You remember Ray Gunn from the Olympics? Yeah, I put a little bit of breaking video on there. It was originally going to be. It was originally going to be. Has anybody heard the name Jean-Claude Van Damme? Okay, so Jean-Claude Van Damme was a very famous martial artist back in the 1990s. But before he did martial arts, he was extra in like movies. There's this one movie. It's called Breakin'. It was a really cheesy movie about breakdancing from the 1980s. There's a scene in here him dancing in there, and I thought this is one of my favorite scenes, seeing Jean-Claude Van Damme dance. And I thought nobody knows who Jean-Claude Van Damme is, and nobody's ever seen this movie. I am really old. So I decided to put Ray Gunn in there because everybody knows who Ray Gunn is. Actually, does everybody know who Ray Gunn is? The Australian breakdancer in the Olympics. Yeah, yeah. Really good. It was some pretty impressive stuff. Definitely better than my dancing is going to be in that video. Yeah, so please watch that before we come to class on Wednesday. So that's chapters 14 and 15 on Monday. We're going to cover chapter 16 on Wednesday. Then we'll have our final homework assignment next Friday. Next Friday, your professional interactions are already also due. Several of you have already submitted those. If you have done so, great. If you've not, please make sure you get those in. They're not difficult. It's just, I'm assuming everybody's done their professional interaction right now. It's actually really nice. I started doing the professional interaction like 7, 8 years ago, just as a way of trying to motivate people to do their more network expansion. And this year, a lot of people in the School of Business, a lot of the other instructors said, that's a really good idea. And I was like, well, that's amazing. People are actually admitting that I have good ideas. But yeah, so a lot of other instructors started doing similar things with their classes. And so now it's basically easy to get students to do it because they have to do it for multiple classes. So it works out well. As Jeb done professional interaction, make sure you submit your write-up. The write-up is just 2 paragraphs, what the presentation was about, what you learned from the presentation. That's all there is to it. Then we have excitement brewing. Exam number 3 the following Monday. So we'll have a review. Exam study guide and practice exam are posted as before. Please complete the practice exam before we come into class. We'll do our normal review session, and then we'll have our exam 3 the Wednesday before. We will not meet as class on Friday before Thanksgiving break. I'm trying to figure out exactly how I want to present results because the simple truth is I don't want you all to be paranoid for an entire week and a half about how the exam is. I don't want to ruin your Thanksgiving that way. I would like to present results. I may record like a brief lecture to talk about it, to like just post a video if you're just curious about it. But I do always try to pair that because my experience is Truman students, they tend to be a lot harder on themselves than I am on you. Like my criticism of you is far, far less than your criticism of yourself. So that's kind of why I try to make sure that I don't expose grades, because everybody's kind of like, oh my gosh, I got a B. This is the end of the world. I said, no, no, this is not the end of the world. You're fine. Everything will be fine. Even if you got less than a B, that's fine. There's never going to be the end of the world. So I'll try to figure out what we're going to do that. I may just post grades and I may just say, hey, this is fine. You guys did a fine job. I would say that in any context, unless everybody got like single digits, then I would say there's a problem. But if everybody got single digits, I probably wrote a bad exam. Okay, that's the truth. Wait a minute. I don't want to inspire that behavior, because now you could collaborate. Okay, you could collude with one another and say, let's just get all the questions wrong, and Dr. Barnes will wonder if he screwed the thing up. And it's like, now that I know that you're going to be up to that, now I've got controls in mind. Although that's an inherent limitation of controls, so there's the problem. All right. Yeah, don't collude. Don't collude to bypass my exam. We will discuss the results officially on the Monday before break, and then we have group presentations on Wednesday and Friday. 2 presentations on Wednesday, 1 on Friday. While you're thinking about your presentation topics, please also think about when you'd like to present. Most importantly, if there's a certain date you cannot present on, please make sure you make me aware of that as soon as possible. The only reason I bring this up is because I've had many, many times in past situations where somebody let me know like the week before presentations, like, oh, we're scheduled to present on this date, but I can't present on that because I have a pre-existing event. I'm like, how long did you know about this event? Well, since the beginning of the semester, I just forgot about it. Okay. I'm asking you now, look at your schedule so that you can know if you're available on Wednesday or Friday. And if one of those doesn't work, let me know now. All right. We good? I've covered through the end of the semester. Is there anything else to go? I can go next semester if you want me to. I don't expect any of you to be here, but I'm happy to do it. All right, here we go. Get into homework. All right. Homework on this. There's some good questions and some bad questions. I try to pick the best ones. My ultimate goal in this class, and I haven't had the time to do it, is to write my own questions for homework, because sometimes the book hits or misses. I will tell you the ones that I think that are really valuable as we're going through this. So question number 1215. Which of the following following procedures would most likely be considered a weakness in any's internal controls or framework? This is a fine question. It's not a particularly difficult question, though. So let's just go through the answers. A voucher for the amount of the payroll is prepared in the general accounting department based on the payroll department's payroll summary. Does that sound like a weakness to you guys? No, it sounds like a really fine procedure. I'm happy with that procedure being performed. Payroll checks are prepared by the payroll department and signed by the treasurer. What do you guys think? You have a problem with that one? I have no problem with that one whatsoever. Okay. That actually makes complete and total sense. Okay. If they're signed by one department and authorized by another. The employee who distributes the payroll checks returns unclaimed payroll checks to the payroll department. What do you guys think about that one? That seems to be a bit of a problem. Okay. So employee who distributes payroll checks got custody of those assets. Okay. You say, oh, unclaimed checks. I'm going to return them to the entity that records the transactions. So custody and recording being both in the same hands, the same individuals. Do we see a problem with that? That's a violation of segregation of duties. And then the personnel department sends employees termination notices to the payroll department. That's just a good protocol. It's a good procedure. So C is our answer. All right, moving on to 1218. The purpose of segregating the duties of hiring personnel and distributing payroll checks. So by the way, there will likely be at least one question, if not multiple questions along this vein, as well. I will ask you, looking at procedures within certain process areas and identify the violation of segregation of duties. This one's pretty easy, okay? But basically, let's walk through the procedure, all right? All right, so purpose of hiring personnel, okay? So that's gonna be HR. What did we say HR's responsibility area was? Was it custody, authorization, or recording? Authorization. They're an authorization responsibility, okay? And distributing payroll checks. Well, payroll checks represent asset in the organization. So this is basically custody, okay? So we're separating out authorization and custody. Now, you don't even have to look at the answers to know that that's the case. But if we read through the answers, there's one that actually says authorization of transactions from the custody related assets. That's a pretty easy takeaway once you identify those two particular process areas. So keep that in mind. That's your approach you should take, is to identify what are the functional areas that are being talked about in the question and see which answers are specific to that. Now, I will tell you, I will be a little bit more, I don't know if devious, but it's also direct. Devious and direct is that I will probably provide you just with the segregation of duties responsibilities. Like I'll say custody authorization, custody recording authorization. I'll talk about each of those. All right, so you'll have certain pairs that you'll look at, or it could be all three are separated or none of the above. I don't know none of the above. Never mind, all of the above. Okay, So these are this is the type of question you could see, although it'll be framed a little bit differently. Question number 21. Which of the following audit tests would most likely be used to test the occurrence assertion for payroll transactions? So occurrence is existence occurrence, okay? So that's basically what we're going to be looking at. All right. Trace a sample of timesheets to the payroll register. So first of all, is trace being used correctly in this context? So trace is basically bottom to top. So we're talking about a source document to the system. That's tracing. That's correct. So what assertion are we looking at here? Completeness. So that's not existence occurrence. It does test an assertion, but it's not the one we're concerned about. Recompute the mathematical accuracy of a sample of payroll checks. All right. Is this an existence occurrence test? VAA. Recomputation is only VAA. Okay. Trace a sample of payroll checks to the approved timesheet summary and the employee master list to verify validity. All right. Is trace used correctly here? It is not used correctly here because if you look, it says the checks moving down to what the source documents for those checks were and the original file, HR file that was used to create those checks. So we're moving from top to bottom, which is what? Vouching, okay? So is anybody else angry that they used trace incorrectly? Show your hands. We're angry, okay? We're going to stand together in anger. All right, yeah. So they did not use this correctly. I would not do this to you on the exam, by the way. If I mean vouch, I'll say vouch, okay? But this is a good test. You have to identify this is not tracing, this is vouching. Is this VAA, or sorry, is this existence occurrence? Yes, because it's vouching, it's existence occurrence. All right, and then test a sample of timesheets for presence authorization. That's just authorization, which is not a real assertion anyway. All right. Oh, by the way, in case you're wondering, I'm going to show this to the camera. You can actually see that I've got my answers. I've got R written. I'm really frustrated. Okay. So you can go back in this video and you can put a like in there. So Dr. Barnes is angry. Yeah, I really appreciated that. All right. Question 23. Auditors most likely to perform substantive test of details on payroll transactions and balances when what? Okay. Cutoff testing indicate a substantial amount of accrued payroll expense. Is that a concern? No, that's pretty much commonplace. You very rarely do period ends end cleanly on the period days of the week. Like if you got paid on a weekly basis, then you're probably going to have an accrual payroll expense, or biweekly. They just most years do not end on the end of the week. Level of control risk relative to payroll transactions is set at low. Okay, so control risk is at low. All right. What does that mean about substantive test of details? Does that mean what is that? So first of all, let's say control risk is low. That likely means that our detection risk is high. Okay, if detection risk is high, what does that mean about the substantive testing we have to do? Less work, not nearly as much, near the scope of details. So if it's set at low, then we're less likely to perform substantive test of details of payroll transactions. Now, we will still perform them, but we're not going to perform nearly as many. What about substantive analytical procedures indicating an unusual fluctuation in recurring payroll entries? Let's think about the steps. We're in substantive testing. We perform our substantive analytical procedures first. We look and we see this is weird. This ratio in past has been 20%, but now the ratio is 35%. I didn't expect to see that. Would that be something as an auditor that you say, I had something that defied my expectation. I'd like to investigate that further? Yes, okay. So we see something that's anomalous to our expectations that gives us a cause for conducting further testing in that area. So that would be an indication of where we want to perform additional substantive test because of something we observed in substantive analytical procedures. So C is our answer, but let's go to D. D, accrued payroll expense consists primarily of unpaid commissions. I mean, that's really contingent on the situation. This would be an it depends answer. This is definitely not the best answer. Now, if we have an organization where their payroll expense consists of multiple items, we'd look at this and say, that's weird. Why is it only this item? But if we have an organization where that's going to be the only item that gets accrued, that's perfectly fine. So it depends on the scenario, but it depends is not as good an answer as C, which is absolutely. All right. Moving on to chapter 13, multiple choice question. Which of the following control activities would be most likely to assist in reducing control risk related to the occurrence of inventory transactions? So do we have an assertion here? Yes, existence occurrence. All right. What would be your biggest concern with respect to existence occurrence and inventory? All right. So is it that inventory does not exist? Okay, obviously that's our big concern. But in what ways can an organization have inventory that does not exist? So there's a couple of different ways. They could have people stealing the inventory. Okay, is that a possibility? Or they could have people reporting inventory that didn't actually ever get received. Okay, So inventory is misstated, either that's been stolen or inventory is misstated by the fact that they said there was a purchase and that purchase never took place. Okay. So what would be some possibilities with respect to the occurrence of inventory? So what would we want to make sure? So the inventory manager does not have the ability to record inventory transactions. Is this a segregation of duties issue? Yes. The inventory manager is probably supervising the custody of the warehouse, making sure everything's in place. That person has custody and the ability to record transactions. What can they do? Okay. If you had the ability to record transactions, and you also had custody of inventory. Just think about cash, okay? If you had custody of cash and you could record cash transactions, could you record cash transactions to your own wallet? Absolutely, absolutely. Can we do the same thing with inventory? Not to our wallet, obviously, but could we steal inventory? Is that one of our concerns about existence occurrence? Yes, it is, okay? So that's a pretty easy answer right there. Let's go through the rest just to make sure, though. Summary of the receipt reports is independently compared to the inventory status report, okay? That's a good check, but is that going to address the or reduce the control risk related to occurrence? Probably not. Inventory is periodically reviewed for slow-moving or obsolete items, which may require a write-down. When we talk about slow-moving or obsolete items, what is our assertion that we're usually concerned with? So slow-moving is basically inventory is being held by the organization at a certain cost, but it's actually worth much less than what they have it in their books for. What would that sound like to you guys? VAA, okay? So that's a VAA concern. Subsidiary ledgers are periodically reconciled with inventory control accounts. Again, that's a good practice, but that's probably more about VAA testing than anything else. So we're talking about occurrence. A is probably our answer. Independent internal verification of inventory, i.e. proper segregation of duties, occurs when employees who, all right, let's go through each one. Issue raw materials, obtain material requisitions for each issue, and prepare daily totals of materials issued. So this is probably a good operation, but does this have to do with segregation of duties? This has been interesting, by the way. So just as a context, last year in my graduate class, we went to ChatGPT and we put in several questions, some auditing multiple choice questions in here. And one thing we came to the conclusion on is ChatGPT cannot actually identify a right answer. They can identify a correct statement, but they can't find it consistent with the statement. Is this a correct statement? Absolutely. Is this a statement that refers to segregation of duties? No, it does not. Okay. Compare records of recorded or records of good on hand with physical quantities. The employees who compare records of goods on hand with physical quantities do not maintain the records or have custody of inventory. Okay. That sounds like separation of three responsibility areas: custody, authorization, and recording. What does that sound like to you guys? CAR. Sounds like segregation of duties to me. Okay, so that's our answer. Obtain the receipts, transfer completed work to finished goods, and prepare a completed production report. That's fine. That sounds like something somebody should do. Are independent of issuing production orders, updated records from completed job cost sheets and production cost reports on a timely basis. Again, I don't see any overlap in that particular area. So B is a pretty easy outlier because it talks about all three set responsibility areas. All right, 20. An entity maintains perpetual inventory records in both quantities and dollars. If a level of control risk were set at high, sorry, I got so an auditor would probably do what? Okay, so control risk is at high. Control risk is at high. What does that likely mean for risk of material misstatement? It means risk of material misstatement is probably high. It's very unlikely in our scenarios that we're going to have inherent risk of anything less than high. If risk of material misstatement is high, what does that mean for our detection risk? Detection risk is low. What does that mean about the quality of the work that we need to perform for substantive tested details? We need more assurance. We need more detail, more assurance in that area. So keep that in mind, okay? All right. Insist that the entity perform physical counts of inventory items several times during the year. Boy, that sure looks like a good answer, doesn't it? Does this provide us any additional assurance? No, this is not actually testing a control. This is testing a balance multiple times. What balance are we ultimately concerned with as auditors? Are we concerned about the balance of, if we're on a calendar year, do I care what the balance of inventory is at June 30th during the year? I care only about the balance at December 31st of this year because that's the calendar year in. So testing balances does nothing, okay? Apply gross profit test to ascertain the reasonableness of physical counts, okay? That's actually pretty reasonable, but will that provide us any additional? Is that something we would do in response to having risk control set at high? Does that provide additional assurance with where there are substantive procedures? No, that sounds like an analytical procedure, which can be helpful, but it's probably not going to be helpful enough because we need more assurance. Increase the extent of tested controls of the inventory system. This is an interesting one because, again, it looks like a good answer, but we've already established the controls are bad. So does testing more controls help us? We said control risk is high, so controls are either not reliable or it's not effective to test it. So does testing more controls help us in this regard? No, it does not. Request the entity schedule a physical inventory count at the end of the year. This looks like a very bad answer, okay? But this is in fact our answer. Why, okay? What do we know about year-end testing? Does it provide more or less assurance for us, as auditors? More, because again, we're talking about interim testing, comparing to interim testing. If I test inventory at interim versus testing at year-end, testing at year-end is going to give me more assurance, all right? So if I need more assurance, would I want to do the procedure that provides more assurance? That pretty much makes a good association with me. So even though it's completely non-intuitive based on the answers themselves, the logic suggests that D is our answer here. So this is an interesting one. By the way, this is a pretty big leap in the analysis of the questions. If you got it right and you're able to analyze it, good, okay? If you didn't, this is more of a teaching exercise. I won't ask you a question like this on the exam. I will ask you to evaluate questions along this line, but this one, again, is very, very challenging to navigate. Very challenging to navigate. When auditing merchandise inventory at year-end, an auditor performs purchase cutoff tests to obtain evidence that what? Okay, so what are we ultimately trying to determine with purchase cutoff? Okay, remember that's immediately before and after year-end to make sure that the items that transactions took place are included in the balance or properly excluded. So all goods purchased before year-end are received before the physical inventory count. Is that what we're trying to test? Is it possible that we can make a purchase and then receive it at a later date? Does that happen at all in business? Happens quite frequently in business, okay? Happens quite frequently. So that's not going to be something we're insistent on. No goods held on consignment for customers are included in the inventory balance. If they're held on consignment for customers, they shouldn't be included in the inventory balance. So that's a no-brainer. Goods observed in the physical count are pledged or sold, okay? So is this something we're concerned about with cutoff? If they're pledged or sold, that actually doesn't change anything because we only recognize the sales transactions when they're sent to the customer. That's our performance, our obligation we talked about in the revenue process, okay? So if they're still being held on the docks, then they should be in inventory, okay? They should be in inventory. We don't care if they've been pledged or sold. If they're held in inventory and they're physically present in inventory, that's consistent. So then we have all goods owned at year-end are included in the inventory balance. Sure sounds like something that was related to cutoff, and in fact it is. This one's a little bit misleading because if you remember, cutoff is not a count balance test. It's a test of transactions and events. But keep in mind that the aggregation of transactions and events ultimately establish what our account balances are. So we are testing individual transactions with cutoff, but we are trying to determine what the balance is in inventory ultimately. So that was a little bit misleading, a little bit confusing. I don't like the wording, but it is the correct answer. 1323, inquiries of warehouse personnel concerning possibly obsolete or slow-moving inventory provide assurance about management's assertion of what? Boy, every single one of these questions was a challenge. You know, you had to really, really think about it. Then you got this dummy of a question where it's just kind of like, yeah, okay, obsolete, slow-moving inventory. What's the assertion? I gave you an easy one to end up with. I want you to feel positive and optimistic about the future. This is evaluation. Yeah, it's evaluation. Yeah. All right. Let's move on. So we're going to do one question that that's okay, and then we're going to do one question that I really, really like because it's fraud. I mean, everybody loves fraud. So 1332. So we're actually doing some audit procedures again associated with specific assertions. Now, this question, I was really, really good up until I get to E. And then apparently an editor got a hold of question number E and said, you know, that's not enough information. I'm really going to take my best. I've read some auditing textbooks material. I think I know assertions. So this assertion looks like completeness and accuracy and valuation for presentation and disclosure. That makes perfect sense, okay? Those editors, okay. Yeah, honestly, I wish they'd just chosen one assertion and stuck with it. But to be honest, we can stick with presentation and disclosure and probably eliminate the rest. Okay, I think that's probably the easiest way to approach this. So let's go through it. We've got our assertions. So ensure that the entity has legal title to the inventory, rights and obligations. So what would be a procedure that we'd want to make, but we could perform to make sure that the entity has legal title to inventory? What would be a good way to do it? Probably some sort of documentation that's provided by the entity that we could review, very high level documentation. Can we say loan agreements and meetings of board of directors minutes? Yes, especially if we're talking about inventory contracts and engagements to purchase inventory for long periods of time, not necessarily individual inventory transactions, but for overall inventory purposes. This one's a little bit dicey because I don't think all of these would be captured in loan agreements and board of directors meeting minutes. But if we're talking about contractual arrangements with vendors that are ongoing, this would definitely be a way to do it. So we're going to say 6 because of lack of a better answer. Ensure the inventory has recorded inventory quantities include all products on hand. So completeness. All right. So we talked about a way we can approach to completeness. So we can talk about approach to completeness. So for inventory, are we going floor to sheet or sheet to floor? We do completeness. So remember, we're talking about floor to sheet. We're saying what's in the warehouse, and we're tracing that to the system. Okay. We're talking about sheet to floor. We're saying what's in the system, and then vouching that to the stuff that's in the warehouse. Which one of those is testing completeness? The tracing one, yeah. Floor to sheet. Okay. So which one is it? Okay, which one is it? Selecting a sample items during the inventory count, determining they've been included on the in the count sheets, or select sample recording items and vendors examining supporting and vendor invoices and contracts. Which one of those is floor to sheet? The first one. Select a sample of items during the physical inventory count and determine they've included on the count sheets. So that's test of completeness, which is what we're concerned about here. So 3 is our answer. Verify the inventory has been reduced when appropriate to replacement cost or net realizable value. All right. So how do we determine replacement cost or net realizable value? Who ultimately has that information? The vendors. So we could actually go look at the vendor information and find that. So what if we go examine current vendor price lists? Yeah, that's a good way to determine valuation. All right. Verify the cost of inventory has been properly determined. Accuracy. Interestingly, the answers in the book, I think, is a worse answer than the one that you all probably came up with, because we're talking about VAA. Both of these are just VAA. Can we actually use the same process to test VAA for both of these? If I want to know the cost of inventory has properly been determined, could I just examine the vendor price list? Because that's what the cost is. That's what we paid for it. So one is a possible answer, but the book actually says that we could also use number 4, select a sample of recorded items and examine the vendor invoice contracts, which may be a stronger answer for the specific pieces of inventory items. Say if you purchased at a discount or purchased something on sale, then you would want to know what that specific set of inventory was purchased at. But as general cost of inventory, you could use both, either 1 or 4. All right, and then our one that's about presentation and disclosure and completeness and accuracy and valuation, because why not? But focus highly on presentation and disclosure. What would be the easiest way to validate presentation and disclosure? Presentation is about information that's presented in the financial statements. So what should we look at if we want to determine presentation and disclosure? The financial statements, okay? So let's review drafts of the financial statements. Review drafts of the financial statements, number 2. I think I said compare 3 and 4. I meant to compare 3 and 5. If we take a look at 5, select a sample recorded items on the count sheets or physical inventory count, determine the items are in hand. That's actually sheet to floor. This is our existence occurrence one, but you'll notice we didn't have any existence occurrence items in our list, which is why we didn't use note number 5. All right. The enthusiasm is high, or is enthusiasm low? Which one is it? Tell me one or the other. If it's low, I'm going to get it high because we're about to go into a really fun activity, okay? All right, I'm going to read through this, and I may have some emphasis. All right. Ando Company, a diversified manufacturer, has 6 divisions that operate through the United States and in Puerto Rico. Ando has historically allowed divisions to operate autonomously. So operation autonomously is pretty good, but does that imply that there may be a lack of oversight? Yeah, so it's a little bit of a red flag, okay? Ando does not have an internal audit department. Is that a red flag? Yes, that's a bit of a red flag. Okay. And corporate intervention occurs only when planned results are not obtained. Oh, great. And it was a policy of hiring competent people. Management is fairly conservative in terms of accounting principles and practices, but employee compensation depends on in large part on performance. So basically, if you meet the results, you get a bonus. All right. So what does that imply about incentive? So we talked about fraud back in chapter 4. We talked about the fraud triangle. Can we consider this to be a pressure? Yep. Okay. So we already have that on our line. All right. JP Kumar is the general manager of the appliance division and produces a variety of appliances. Kumar has been able to improve the profitability division in each of the 5 years. Well, good for him. He's probably not doing anything illegitimate in that regard. Okay. Much of the improvement came through the cost cutting, including a substantial reduction in control activities over inventory. Okay. I take back what I said. Recently, a new competitor entered the market, has offered substantial price discounts in an effort to grab market share. Kumar is concerned because if his profitability bond is not maintained, his bonus will be reduced. Okay. So as auditors, is bonus being reduced a rational approach to how we to treat financial statements? Like if he says, well, this is a misstatement, and we say, well, we have to maintain this misstatement because my bonus will be reduced otherwise. Will we accept that explanation as auditors? Hopefully not. Hopefully not. Now, if you want to nod your head, okay, yeah, that's up on you. Kumar decided the easiest way to make the appliance division more profitable was through manipulating inventory, which was the largest asset on the books. Kumar found that by increasing inventory 4%, income would be increased by 8%. We talked a little bit about this on Wednesday. When we increase ending inventory, that's going to decrease our cost of goods sold. And we decrease an expense in the income statement like cost of goods sold. What does that do to the bottom line? It increases the bottom line. Okay. So that's the explanation there. We could go through the mathematical operations. I'm sure that you all are capable of doing that. Just trust me when I say when you increase ending inventory, it generally increases in net income. And that's because we're trying to hold everything else constant. With the weakness of inventory control, he felt it would be easy to overstate inventory. That is just working smarter, not harder right there, folks. You actually cost cut by cutting internal control, and then you use that same deficiency in internal control to disguise your fraud. Okay. I kind of want to be like JP Kumar when I grow up, I'll be honest. Yeah. All right. Employees count the inventory using count sheets, and Kumar was able to add 2 fictitious seats during the physical inventory, even though the auditors were present and observing the inventory. This is just auditors with the incredible level of trust, no professional skepticism whatsoever. Says, oh, 2 additional count sheets works for me. All right. Significant amount of inventory was stored in the racks that filled the warehouse because of their height and the difficult test of counting them. Kumar was able to cover his overstatement inventory in the upper racks. This actually just pisses me off. Okay. This actually just ticks me off because I had to climb to the top of those oil chemical storage towers in the middle of winter to drop that measure down and then count to that. And these people are just kind of like, oh, it's so high in the racks. I don't really want to climb a ladder. Okay. Yeah. By the way, has anybody ever heard of Crazy Eddie? Has anybody ever heard that term? So Crazy Eddie was a very well-known electronics retailer in the 1980s and 1990s in the Northeast, like primarily in the New York area. They had massive financial statement frauds, and the reason they were able to get away with a lot of it is auditors would come in, they'd say, hey, you don't want to climb that ladder. Let us kind of go up there. We'll count and yell the inventory down at you and say what's up there. And so they would just completely and totally make up numbers, just completely and totally make up numbers. That's what I think of when I said that. And plus that I'm upset that somebody used a justification of not climbing a ladder as a reason why they couldn't count inventory. I climbed a chemical storage barrel, for crying out loud. After the count was completed, Kumar added 4 additional count sheets that added $950,000 or 8.6% to the state inventory. Kumar notified the auditors of the omission, and the sheets convinced them that they represented overlooked legitimate inventory. So yeah, after the count is done, say, hey, by the way, here's some count sheets that I didn't give to you. All right. Red flag? Yeah, maybe. Okay. It's obviously in the case. Here's the thing that really, really gets me. Okay. Now, hopefully you all picked up on this. And if you did pick up on this, kudos to you. All right. Kudos to you. The auditors traced the items on the additional sheets to purchase invoices to verify their existence and approve the addition of $950,000 to inventory. All right. Is tracing used correctly in this scenario? No. I'm not saying does tracing verify existence, but is the term tracing used correctly in the direction the auditors move in this particular scenario? It is used correctly here, okay? The term tracing is used correctly, which is a problem because they use tracing to verify existence, okay? They used a tracing procedure to verify existence. So they said, let's go ahead and take these inventory cost sheets. Let's go and trace them to the invoices. Oh, look, these invoices exist, okay? So the inventory must exist. If you get count sheets, what are you going to go check the count sheets against? Is it going to be the purchase invoices? No, it's going to be the actual friggin' inventory. I almost used a bad word there. Yeah. So it's going to be the actual inventory. I don't actually swear. So actual inventory. And they said they look at the invoices. Is it possible, pray tell, is it possible that JHB Kumar could have made fake invoices? No, it's not possible at all. So that was a really big one right here is that tracing, they did tracing, but tracing doesn't test existence. Okay. So really big problem right there. Really big problem. Also, they did not notify management they added sheets. Well, it's not a big deal. It's only 8.6% of the inventory. In addition, Kumar added other count sheets for sending the auditors and changing audit designations. For example, 6 motor mounts, 6 motors, raising counts, adding fictitious line items to complete sheets. Fictitious changes added another 375,000 to the military inventory. None of them was detected by the auditors. So this is an example of what not to do as an auditor, okay? If you've got somebody who's bound and determined to commit fraud, this is not how you approach it. Let's talk a little bit about it. I've already kind of dissected this to some degree, but let's go ahead and identify what's going on. So what audit procedures, I'm going to scroll down. What audit procedures do the auditors apparently not follow that should have detected Kumar's fraudulent increase of inventory? All right. So first of all, can we say that the count sheets were a problem? So the very first thing that we do, we go into inventory. Remember I said we had to make sure that inventory is controlled very heavily. I want to make sure there's no movement of inventory and the count sheets are obtained prior to the inventory and there's no changes. There were not only changes, there were multiple changes in the count sheets. They added 2 right before the inventory count. They added another 4 after the inventory count. And then, lo and behold, the auditors didn't even know about 3 that were added after that, okay? So the inventory count sheets, they had no control over whatsoever. So the control over the inventory count sheets is certainly a problem, all right? Now, if they do add, is it possible that there's a legitimate reason to add inventory count sheets, okay? So what would you do? Just practically speaking, I'm not even talking about an auditor, but let's say you're in this role of responsibility. You have no audit training whatsoever, which you do now, okay? But you had no audit training whatsoever. We're talking about you before you started the semester. And I said, hey, let's talk about the philosophy of inventory count. So you've got these count sheets that match what the inventory is. And then somebody at management comes and hands you additional sheets. Are you going to take that at face value? I'm assuming most people would say, no, that sounds really, really weird. Logically speaking, it is weird. If that's the case, if something weird happens, would we want to try to determine why something weird happened? Yeah. Why did inventory count sheets get added so late? Are these legitimate? Can we figure out where this came from? What was the reason or what was the rationale behind it? They said, well, one of the employees forgot to prepare these sheets, and I basically had to follow up with him. So, okay, can I talk to that employee? No, you can't talk to that employee. That would unravel my fraud. Okay. So something along those lines, verifying how information should be disseminated, just doing some due diligence, for crying out loud. All right. The one that we've already identified, one of the big ones. This is one that it's really, really easy to look over, but making sure that when an auditor performs a procedure, that it's consistent with what the procedure is they're trying to accomplish, what the assertion is they're trying to test. Remember, I told you when we were talking about test of controls, I had to make sure that you understood when you perform a test of control, it has to be consistent with the specific assertion. And even though that seems very easy to gloss over to see tracing the item on the inventory sheet to verify existence, that wording right there should have been a big alarm. You may not have exactly known why, but you said, no, we don't trace for existence. They must have used tracing wrong. That's the natural inclination because we've already told you that they used tracing wrong. In this scenario, the word trace was used correctly, but we know that tracing doesn't test existence occurrence, okay? They did not verify the inventory. They verified what looked like to be the purchase of inventory and tried to validate that against external records. And if we do that, we know that that's evidence, but it could be very easily falsified. You know what can't be falsified? Actual inventory, okay? Unless, of course, you ever saw the movie Sergeant Bilko with Steve Martin, where basically they held up a mirror to actually reflect what the boxes were, and then it looked like they had twice as much inventory. That's a way to falsify inventory, I guess, okay? It's so funny what's in the movies. It's not nearly funny when you're doing the audit, but yeah. Also, an interesting question here. Interesting question that's kind of, we talked about the control of the sheets. We talked about the inventory count procedures. We talked about the failure of the auditors. Are there any other ways that we could have identified anything that might have been outlying? So real quick to count. So we know that there's a lot of ratios that relates to inventory. If they had falsified this much inventory, we're talking on the scale of like somewhere around 10% of the inventory between that 950,000 plus the additional 375,000, somewhere on the scale of 10% of inventory, would that have affected inventory ratios? Okay. So what would be an easy way for an auditor to detect if something was just a miss? Before or after the fact, or after the fact? Analytical procedures? We look at the ratios and say, okay, well, inventory turnover is on average 13 times per year for previous years. And then the current year inventory turnover is 2. Oh, that's weird. I wonder what happened here. You might want to know why that ratio changed so substantially. Is that direct evidence? No, but is that indirect evidence that might cause you to try to find direct evidence? Yes. So there were a lot of things the auditors could have done in order to be able to answer these particular questions, and they just did not legitimately follow the rules. So what are the implications for those an auditor who's failed to detect a material fraud described here? So we talked about this as a general rule. A general rule, the auditor has to develop procedures for fraud or illegal acts that have a direct and material effect on the financial statements. Okay. Now that's important to note because we're not responsible for every level of fraud. Generally speaking, we should be able to, if we do identify a fraud, it doesn't really matter what the materiality level is. I mean, that's a general rule. I mean, if you find out the CEO is stealing a pack of gum every year, that's probably not something that you're going to report to the SEC. Okay. But for the most part, if we find fraud, it doesn't really matter what the materiality is. That being said, our procedures are trying to identify fraud that has a direct and material effect on the financial statements. Is this direct, this particular scenario here? Yeah, he's overstating inventory. Is it a material effect? Yeah, it actually says material in the question. So would we be held liable for that as auditors? Yes, absolutely. Absolutely. Okay. And what does that mean for you? What does that mean for you working in the firm? Well, if you're probably a staff auditor, you just kind of like hide behind the shroud of innocence. It's like, I didn't know. My senior didn't tell me. The senior said management was not involved in this. And management said, yeah, it's my bad. And the partner would say, yeah, I'm the one who's ultimately going to pay for this. Okay. So if we're talking about a fraud, it could be very severe. It could be the problem, basically a sanction or censure of the firm itself. And the individuals involved could actually be penalized in a lot of frauds that have happened in recent memory, the partners and the managers involved, they were actually prohibited from practicing audits for a significant period of time, usually like a 3-year period. Say, yeah, you can't perform audits for 3 years, which doesn't mean that you can't continue doing accounting. It just means that people are probably not going to want to rely on your accounting services pretty heavily because you didn't detect a fraud. So something to concern yourselves with. All right. According to the audit standards listed at the start of the chapter, what responsibility auditors have to discuss the concerns with the entity's audit committee? So we didn't really talk specifically about the items in the chapter, but what is our responsibility to discuss with the entity's audit committee? Do we have a responsibility to communicate? Yes. What information was disclosed in here that you think probably should have been talked to the audit committee about? Inconsistency of the count sheets. Okay. Inconsistency of the count sheets. Problems with the internal control reductions. That's probably something that's been very, very obvious. Concerns about risk environment. Should the auditors know about the changes in the operating environment of the organization with the new competitor that's putting lower prices? That represents a new risk. What does that mean? It means that we need to have better controls to compensate, not worse controls. Okay, that client has controls to compensate. All right. Uh, should there be any information about any of the anomalies that were talked about at the end? Should we have disclosed that to management and the audit committee? Management, at the very least, yes, to say, yeah, this was really weird. We conducted our audit count, our testing count, and then the manager came in and gave us 4 new count sheets. That really made us uncomfortable. It really made us uncomfortable. But to be honest, we traced to test existence, so it worked out at the end. Okay, it worked out in the end. Now, this again, more communication is definitely going to be better than less communication, and more transparency. The audit committee will give us a bit more guidance in that area. So this was one of those ones where there was a whole lot of things that were very easy to find wrong, but trying to get to the nature of it and figure out what our responsibility is, this was just a complete and total failure in many, many different ways. Some of them were very obvious. Some of them were a little bit more subtle, but all of them are very important. So hopefully you hold on to that as you're preparing for the exam, and keep in mind that you will have to critically assess these type of information moving forward. All right, we are done with this. We got one more set of chapters to go through next week, and then we're done with lectures. Have a good weekend. See you then.